Good to have you with us. I mean, we know this ruling is positive, even if it's just for 150 days. What's your take on it? What impact will it have in the immediate future?
Good morning, Haslinda. Good to see you. I think three specific areas of conversation that I've been having with business leaders across the country and across the ocean. One, the subject of refunds. The American consumer makes up 70% of our economy here in the United States. And if they've been overcharged, they're going to want that refund, as will more than hundreds of thousands of companies who've paid these tariffs to accept their imports and now are banding together and organizing to do just that. The second segment is what took place over the weekend. Many companies were working on their ledgers and trying to calculate what their new effective tariff rates would be. Now, these tariffs under Section 122 of the Trade Act are a lot more prescriptive, have many more exclusions, and are temporary, which means there will be more debate, more capitulation going down the line, and more uncertainty. Thirdly, what does it mean for a port like ours as a leading indicator of the U.S. economy? Coming off of Lunar New Year is traditionally a slow season. So if there is an uptick of cargo, it can be managed very well. And we see it coming weeks in advance. But realistically speaking, it appears that the effective tariff rate will be lower for many who buy, especially from Asia countries that are shipping here to the United States. But all of this remains under one complication, and that's that announcements keep coming out so fast and furious that it's tough even for the most seasoned professional to keep up with all of this.
Eugene, on the issue of refunds, some say some consumers at least, may not even see that refund. Is that a fair assumption?
There were cabinet members in the United States on the news shows over the weekend saying just that. And if there is a possibility, it will take some time. But these are the people who fuel the U.S. economy. And it's going to be interesting to see what that grassroots appeal is on this subject. If they were being charged more for coffee and bananas, footwear and furniture, there's going to be some talk that goes on for some time on this subject.
Gene, what's the impact on the Port of LA? What are you expecting in terms of volumes? How much more are you anticipating? And what kind of, trade mix are you looking out for?
As we headed into the New Year holiday, I said that we would probably see a single-digit decline in cargo volume for year 2026, mainly because we front-loaded so much cargo in and out of all the tariff announcements last year. With this latest run, including the Supreme Court's decision, it's going to be very interesting to see. Again, if that effective tariff rate for some companies and importers is lower, we may see some cargo really shoot through the system pretty quickly. One area that has not been discussed is that of the American exporter. Through all of these trade discussions, they have been left hanging in the balance. Soybean shipments from the United States to China last year were down 90% and down 80% from our port alone. We've also seen exports decline 9 out of the last 13 months. So while we've seen fits and starts on imports really based on trade policy announcements, exports have been left behind. And much more discussion needs to be had to bring that particular segment back into the mix. They play a lot towards growing our GDP.
So do you see the ruling of the weekend changing that in the immediate future? Do you see China buying more U.S. soybeans, for instance, keeping the promise that Xi Jinping made to President Trump?
Now, we're not sure. Now, coming off the sidelines of APEC last November, there was talk of increasing those soybean purchases. But those contracts that are held now with other countries like Brazil and Argentina are in place for 3, 6, and 12 months. This is not a transactional business. And what we saw in 2025, as it concluded, Haslinda, was the largest trade deficit in U.S. history since 1960. There's much more work to do here.
What we also heard from the U.S. is the suspension of de minimis. Does that necessarily change things for China?
It could. Now, the de minimis, any package that comes in from an overseas market to the United States, at less than $900 per unit. That loophole was pulled last year, and taxes on those products went up dramatically. Now, if that comes out, we probably see a lot better business for the direct to home consumer and also the small business person who relied on their storefront to be filled with products that were brought in these smaller parcels. We also saw some activity on the legal side today from Federal Express based in Memphis. So this is a piece of business that's been growing at an exponential rate and has an impact on families and small businesses. We'll be watching this closely.
What are some of the risks, Gene, that China will continue to pull back on its exports to the U.S.? What are the signs you're looking out for?
You may remember I was in China during the announcement of the 15th five-year plan. And one of the statements, translating over, of course, was that we no longer only export products, but we're exporting our manufacturing expertise. So while cargo from China to our port, as one example, has declined from 60% of our business down to 40%, we are still growing because we've picked up a lot of cargo from Southeast Asian nations, and China's investing in those countries as well.
Can you quantify that, Gene? I mean, you talk about how Southeast Asian nations are picking up the slack. How much are they doing that? Because we know eventually no country, even not a number of countries, can actually replace China as a market.
That's right. And there have been statements about how many Vietnams it would take to replace Guangdong province alone in South China. And you're exactly right. But volume for volume, we had a net increase in imports to the United States from Vietnam, Indonesia, Malaysia, Cambodia, just to name a few, compared to the decline we saw in China shipments. Now, how long that can last, how resilient that trend will be, time will only tell. But at this juncture, between investment, expansion, and importers going to markets where there's just a little bit less drama, a little bit less concern about geopolitical interests over this next months and 12 months in 2026, you'll probably see that trend continue in the intermediate time frame. As
you said, you know, when it comes to shifts in trade trends, they tend to be long term because it's a lot of investment and it's hard to change, given the longevity of that trend. I'm just wondering, in terms of regional trends, are ASEAN countries, for instance, doing more business with each other? Is that the way forward for a lot of the regions? Oh, I believe so. And what we've seen in the broader statistics, Haslinda, is that while China's exports to the United States in 2025 declined, China's exports to the rest of the world grew by double digits. We're also seeing trading nations move in different directions. The India agreement with the EU, Indonesia's work individually with the European Union, all have started to foster deeper relationships, some pre-existing, but more so than we've ever seen before. Many of these other pieces of work, it's soybeans coming out of South America, almonds from Australia, and additional work across South Asia leads us to see that exactly that. The trends are moving where countries are ramping up their relationships with partners outside the United States. And how is that shaping your investments and your growth plans going forward, say, maybe the next 3 to 5 years? Well, because of a strong and prudent financial policy, we're in great financial shape at the Port of Los Angeles, annually doubling our revenue and putting that to work in infrastructure projects. We have a view of the long-term investment. We have to invest through cycles, whether it be budget, economic, or even election cycle. We've now got projects, a brand new marine container terminal, the first in a generation, deeper investments in brownfield projects, aspirational hopes for a new bridge connecting our workforce to the industrial sector of Terminal Island, and a new $500 million cruise terminal to bring even more visitors to Southern California. So those investments are tracking. They will be longer range, and they will promote that great economic development that the Port of LA has been known for over the past decades. Gene, as you think about expansion and investments, how are you taking geopolitical risks into consideration? Case in point, Hutchison Port, operating in Panama, running into trouble there. How are you assessing such risks?
It certainly is a very different landscape than we've been accustomed to. But here at the Port of Los Angeles, the cargo that moves through our complex reaches each one of our nation's 435 congressional districts, all 50 states. So it truly is a conversation of national significance. And as we look at our partnerships here on the ground with our private sector supply chain stakeholders, the strength of those relationships is stronger than ever. This port and our neighbor in Long Beach account for 40% of the United States containerized imports and about a third of our exports. This is critical to the economic engine of the United States.
You're within the same industry, Gene. I'm just wondering your views on how disruptive it is for what's happening to Hutch in Panama. What implications are there for the industry?
The world order of trade has been upended over the last 12 to 15 months. There is no doubt about that. With folks trying to pick partners and choose where they can do business, who can partner with whom, and where exactly their strategic visions are going to go in the future. We've got to keep our eye on the prize here, and that is driving American economic growth. When I look out my window at the port, I see a $33 trillion economy in Asia that we've traded with for so long. And that is extremely important. Opening up new markets and going deeper into those existing markets with U.S. exports, especially agriculture, will also propel this GDP. More exports against the backdrop of imports continues to mathematically grow GDP. And that's where the focus must be. But looking at that global landscape today, the partnerships and the trade lanes are certainly changing. We have to stay ahead of the curve.
So which markets are you most excited about? Which markets will see the most growth?
Well, realistically, I don't think you'll ever decouple from China as the United States when it comes to trade. These are decades-long relationships, and the know-how from manufacturing to supply chain and delivery of products. Strategically, rules-based trade is an American imperative to make sure that we protect those iconic brands and jobs and our growth aspirations along with national security. But as an example, Haslinda, today there are more than 400,000 manufacturing jobs open in the United States. We need to be focused on attracting, recruiting, and retaining skilled labor that can go into these jobs for more manufactured outputs that can be sold to world markets. That's where I think we have a big upside. In addition, Los Angeles County alone, we have 400,000 manufacturing jobs in place today with two great ports in the backyards of these manufacturing facilities. Yet, those folks combined only export 1% of their output. We've got a pilot case right here in place to do more and get many more companies introduced to international trade and expand their customer base while selling their products. There are opportunities within the supply chain that can help American economies and our trading partners.
Gene, you said earlier that you don't expect full decoupling within the U.S. and China, but strategic decoupling, that's what people are saying. Eventually, though, can you expect volumes from China to keep decreasing as a result of that?
Yeah, I do see it declining. I just don't know where the floor is right now. As I mentioned, we went from about 60% of our portfolio business with China back in 2018. It's declined to about 40% last year, and it's still dropping a little bit. I don't think that if you compare it to its second biggest trading partner, the Port of Los Angeles, China is still 2.5 times larger than that of our trade with Japan. So there's a big delta here as far as the imminent demise of one trade lane and one partner. But realistically speaking, others will have to pick up the slack, from manufacturing capacity to know-how and getting goods to market. One thing that's not been discussed enough is, believe me, the manufacturer in Vietnam knows exactly what the landed price of a product coming out of China to the U.S. is, and is not offering steep discounts. Raising prices in one segment through tariffs leads to higher prices in other segments. And we're seeing that geographically as well. So making sure that we have an eye on affordability, which is now a nationwide conversation here in the United States, must be part of that strategic thinking in the private sector and in ports like us.